Welcome back to the grey metal. Silver just crossed $100 per ounce, and the financial media has made their verdict. Bubble Bloomberg says it's overheated. CNBC analysts are warning investors to take profits. The narrative is clear. This is speculative excess that will end badly. But here's the problem with that narrative. If silver at $100 is a bubble, then you have to believe that China, the world's largest manufacturing economy, is making a strategic mistake. You have to believe that the global solar industry, Tesla, Samsung, and every major electronics manufacturer are all wrong about supply conditions. You have to believe that physical premiums, refinery backlogs, and structural deficits are all illusions. The media is calling this a bubble because the price went up, but price movement alone doesn't make a bubble. Fundamentals do. And the fundamentals of silver right now are the opposite of a bubble. This is physical market reality, breaking through years of suppressed pricing. Over the next 17 minutes, I'm going to show you what's actually happening in the silver market, and why this rally is just beginning. This is the grey metal. Let's break down the data they're not showing you. Let's start with the single most important factor that makes this rally fundamentally different from anything we've seen before. China. The Shanghai premium right now, silver in Shanghai is trading at $110 to $112 per ounce. In New York, it's $99. That's an $11 to $13 premium. For context, the normal Shanghai premium is 50 cents to maybe $2, basically just the cost of shipping and refining to Chinese specifications. A $12 premium isn't a pricing inefficiency. It's a signal screaming that there is not enough physical silver available in China at current prices. When physical premiums blow out to these levels, it means the paper price in New York is disconnected from what's actually happening in the physical market where manufacturing happens. The Shanghai premium is telling you the real price of silver in the world's largest industrial economy is $110, not $99. China produces 85% of the world's solar panels. Every single panel requires 20 grams of silver. China manufactures 60% of global electronics. Smartphones, computers, circuit boards, all using silver. China is the largest automotive market and is rapidly electrifying. EV batteries use significantly more silver than traditional vehicles. When Chinese manufacturers buy silver, this isn't speculation. They're buying input materials for production lines that cannot function without it. This is the critical distinction. Industrial buyers don't buy silver because they think the price will go up. They buy because without it, the factory shuts down. Simultaneously, Chinese retail investors have deep cultural affinity for precious metals as wealth preservation. When they see manufacturers competing aggressively for silver supply, when they see rising prices, when they see their own currency under pressure, they buy physical metal, not ETFs, not paper certificates, physical bars and coins. This metal goes into private vaults and doesn't return to the market. It's removed from supply permanently. This is what makes China's role unprecedented. They have manufacturing demand that's mandatory and investment demand that's growing. Both are pulling on the same limited supply of refined silver. Both are willing to pay premiums for immediate delivery. This wasn't happening in 2011 when silver spiked to $49. Back then, Chinese participation was limited. The rally was driven primarily by Western investment demand. Today, China is the dominant force, and their buying is strategic, not speculative. That changes everything. Now let's talk about why industrial demand makes calling this a bubble fundamentally wrong. The solar industry consumes 140 to 160 million ounces of silver annually. Each panel contains 0.64 ounces of silver paste. At $99 per ounce, silver costs about $63 per panel. At $130, it would cost $83 for manufacturers operating on 15% to 20% margins. This is painful. But here's what matters. They don't stop buying. Why? Because the alternative is shutting down the production line. A solar manufacturer with a $500 million factory doesn't save money by stopping production because silver got expensive. The factory's fixed costs, labor, overhead, debt service, continue whether they're making panels or not, so they keep buying silver at whatever price is necessary to keep operations running. They absorb the cost, compress margins, and try to pass increases to customers. This is inelastic demand. Quantity demanded doesn't drop proportionally to price increases. Tesla's gigafactories represent billions in investment. These facilities are designed to produce batteries at scale. If silver becomes expensive, Tesla doesn't save money by reducing battery production. Revenue drops while fixed costs continue. The silver content in battery cells is measured in grams per unit. Even if silver triples, it might add $50 to a battery pack that sells for $8,000, compared to the cost of production delays, supply chain disruption, and revenue loss. Paying higher silver prices is trivial. Industry estimates suggest Tesla's 4 gigafactories will consume 90 to 110 million ounces annually at full production, roughly 12% of global mine supply. Samsung's solid-state battery program could require another 120 to 150 million ounces. Combined, two companies could consume 25% to 30% of annual mine production. Apple doesn't stop making iPhones because silver got expensive. The silver in an iPhone is a fraction of a gram. Even at $200 per ounce, it's maybe $3 per device. For a product selling for $1,000, this is irrelevant. What's not irrelevant is supply chain disruption. Missing a product launch because component suppliers couldn't get silver would cost billions in lost revenue and market share. So electronics manufacturers pay the price and keep production running. In a bubble, tulips, dot-com stocks, cryptocurrency manias, demand is optional. When prices rise too high, buyers simply stop buying. Nothing breaks. With industrial silver, demand is mandatory. Stopping purchases means stopping production, which means catastrophic business consequences. This fundamental difference means industrial demand provides a price floor that speculative assets don't have. Now let's examine the supply side, because this is where the structural problem becomes undeniable. Global silver mine production is approximately 830 million ounces per year. This number has barely changed in 5 years. Why doesn't supply increase when prices rise? Because 70% of silver comes as a byproduct of copper, lead, and zinc mining. The economics of these mines are determined by the base metal, not by silver. When silver prices double, it doesn't make economic sense to open new mines if copper or zinc prices haven't also increased. Primary silver mines exist, but they're rare and expensive to develop. Even if a company decided today to develop a new silver mine, production wouldn't start until 2030 or later. Exploration, permitting, financing, construction, the entire process takes 5 to 10 years minimum. The mines that would respond to today's prices don't exist yet and won't produce meaningful ounces this decade. Annual silver demand in 2025 reached approximately 1.2 billion ounces. Industrial, 550 to 600 million ounces. Jewelry and silverware, 200 million ounces. Investment, 250 to 300 million ounces. Photography and other, 50 million ounces. Against 830 million ounces of mine production, you have a deficit of 370 million ounces. This gap is filled by recycling, approximately 180 million ounces annually, and by drawing down above-ground inventories. COMEX silver inventories have dropped 40% over the past 18 months. London vault inventories show similar drawdowns. Shanghai inventories are being pulled to meet manufacturing demand. These are not investor stockpiles being hoarded. These are working inventories being consumed faster than they're being replenished. Here's the factor most analysts completely miss. Refining capacity is the actual constraint. Global refineries can process approximately 850 to 900 million ounces annually. This capacity is relatively fixed. You can't build new refineries quickly. Right now, refineries are running near maximum capacity. Delivery times have extended from 6 weeks to 12 to 14 weeks. When industrial buyers panic and try to order multiple quarters of inventory simultaneously, refineries hit a hard wall. They can't process more silver faster. The chemical processes take time. Quality control can't be rushed. This creates a physical bottleneck, where supply cannot respond to demand surges regardless of price. And when buyers realize they can't get metal even at higher prices, that's when premiums explode and spot prices follow. This is physical market reality asserting itself. The most common comparison is to 2011, when silver spiked to $49 before collapsing. So let's examine how this rally differs. The 2011 rally was primarily Western retail and ETF buying. Chinese participation was limited. Industrial demand was steady, but not exceptional. The rally was fueled by QE1 and QE2 inflation fears, and by speculative momentum. When investment demand peaked and reversed, there wasn't enough industrial support to maintain prices. Silver crashed from $49 to $26 in weeks. Today's rally is fundamentally different. China is the dominant buyer. Both manufacturing and investment industrial demand has structural drivers: solar growth at 15% annually, EV mandates, 5G infrastructure build-out. Physical tightness is visible: Shanghai premiums, refinery delays, inventory drawdowns. Investment demand is rational: inflation protection, currency concerns, geopolitical instability. In 2011, when investment demand stopped, the rally collapsed because industrial demand wasn't strong enough to support $49 silver. In 2026, even if investment demand pauses, industrial demand continues because production lines can't shut down. Solar installations are policy mandated through 2030. EV adoption has legal deadlines. Electronics consumption grows with GDP. This creates a much higher price floor and makes a 2011-style collapse far less probable. In 1980, silver briefly hit $50 per ounce. Adjusted for inflation, that's approximately $185 today. In 2011, silver peaked at $49. Inflation adjusted, that's roughly $68 today. Silver at $19 is nominally high, but we're nowhere near inflation-adjusted historical peaks. If this were a bubble comparable to 1980, we'd need to see $150 to $200. The ratio currently sits around 28.1, meaning 28 ounces of silver equal 1 ounce of gold. Historical average over the past century: 61. During 2011's peak, the ratio briefly touched 32.1. At 28.1, silver is expensive relative to recent decades, but if industrial demand has structurally changed the relationship, a tighter ratio is justified by fundamentals, not speculation. Now let's be intellectually rigorous and examine what could invalidate this analysis. If worldwide economic activity collapses, industrial production would plummet, solar installations would stop, EV production would halt, electronics consumption would crash. This would destroy the demand thesis and likely cause silver prices to fall significantly. If researchers develop a substitute material that's cheaper than silver and performs equally well, the industrial demand story breaks. Given decades of engineering effort to reduce silver content, this seems unlikely in the near term, but it's possible. An enormous, easily accessible silver deposit could flood the market with new supply. Given extensive global exploration over decades, this appears improbable, but not impossible. If China's economy enters severe distress, both manufacturing demand and investment demand could evaporate simultaneously. This would remove the dominant buyer from the market and likely crash prices. If governments decide silver prices threaten economic stability, they could release strategic stockpiles, impose export restrictions, or even implement price controls. Extreme, but historically precedented with gold. If industries accelerate silver reduction efforts and achieve breakthroughs faster than expected, demand could decline more quickly than projected. Any of these scenarios would fundamentally alter the supply-demand equation. Markets are dynamic systems, not predetermined trajectories. But based on current data, current policy commitments, and current structural forces, none of these scenarios appears imminent. The probability-weighted outcome still favors continued tightness and higher prices. So is silver in a bubble? No, bubbles are defined by speculation detached from fundamentals, by leverage-fueled mania, by parabolic price action driven by irrational exuberance. What we're seeing in silver is the opposite. This is a structurally driven rally based on fundamental supply deficit, inelastic industrial demand that can't be shut off, physical market tightness visible in premiums and delivery delays, China's strategic and industrial participation, and rational investment demand seeking inflation protection. Could silver correct from current levels? Absolutely. Volatility is inherent in commodity markets. Could we see $90 before we see $110? Possible. But calling this a bubble fundamentally misunderstands what's happening. The media calls it a bubble because price went up. That's lazy analysis based on charts, not fundamentals. The fundamentals say more silver is being consumed than produced, inventories are declining, refining capacity is constrained, and the largest manufacturing economy in the world is paying $12 premiums for immediate delivery. That's not a bubble. That's physical market reality reasserting itself after years of suppressed pricing. This isn't hype. This isn't hope. This is what happens when physical reality collides with paper pricing. For those asking whether to buy, hold, or sell, I can't give financial advice. But I can tell you, understand the fundamentals, understand the difference between speculation and structural demand, and make decisions based on evidence, not emotion. The deficit is real. The demand is real. The constraints are real. Whether that justifies current prices or implies higher prices ahead is for each person to determine based on their own analysis and risk tolerance, but it's not a bubble. This is the grey metal. If you value analysis over narratives, data over hype, and intellectual honesty over clickbait, consider subscribing. We don't do fear, we do fundamentals. Thanks for watching, and I'll see you in the next video.